I'm Anthony Smith, and you're watching the Chart of the Week. Hello, and welcome to our weekly video. This week's video was inspired by an article I saw on Bloomberg a couple days ago. This is now the worst drawdown on record for global fixed income. That was the headline. And I say inspired because I don't really cover the article's contents in this video, but it certainly got me thinking that a discussion of the recent bond price action would be a good topic for this week. So many of you probably know by now, but just in case, I've been a bond guy since 2004 when I got very lucky and landed a job on a corporate bond trading desk in New York City. And I've been involved in bonds for the most part ever since. In fact, I currently manage the bond portfolio for Community First Bank. So bonds are cool. Don't let anybody tell you otherwise. All right, let's look at a major U.S. bond index, the Bloomberg U.S. Aggregate Bond Index. This index is primarily composed of U.S. Treasuries, U.S. corporate bonds, and mortgage-backed securities. It is down 5.8% year to date. How does that compare with stocks? And in this case, we'll look at the S&P 500. Actually, pretty similar performance. The S&P 500 is down 6.2% year to date. But wait, I thought that bonds provided stability to a portfolio. I thought they were stable value securities. What gives? Well, generally, bonds do provide stability to an investment portfolio, but there are periods like what we're experiencing right now when that breaks down a bit. What is driving this? And it's interest rates. So this chart right here is the yield on the 5-year U.S. Treasury. It is up more than 100 basis points year to date. So it's up more than 1 percentage point. That's a big move. So let's do some quick, simple bond math to illustrate how bond prices react to changes in prevailing interest rates. Let's say you have a 5-year non-callable fixed coupon bond. The formula for calculating an estimate of the bond price change is the duration times the change in interest rates. But you have to get your signs right because remember, bond prices move inversely to interest rates. So when rates are rising, like they are now, bond prices are falling. So let's walk through an example. So 5-year non-callable fixed coupon bond, duration about 5, times the change in interest rates. So interest rates are going up 1%. So 5 times 1%, that is a 5% change in the price. And remember, interest rates are going up, bond prices are falling. So that's why it's a negative 5% swing in the price. If the opposite were the case and rates were falling, then you would see bond prices go up by about 5%. I do need to emphasize that this is a very simple, crude way of calculating bond price changes. It's a little more complex than that. Duration is going to be less than the years to maturity. And then there's a concept of convexity that comes into play. But again, this is meant to illustrate a concept. And what you can see is that the longer your bonds are in your portfolio, the longer maturity they are, then the more pain you're experiencing right now with the rate move that we have had. So we see a lot of prospective clients come in with bond portfolios composed of long-term municipal bonds. And there's a lot of pain in those portfolios right now. What we know about those portfolios is that they make a lot of money for the brokers who sold them those bonds in the first place. That is something we know for sure. That's not the way that we invest in bonds here at HFG Trust. if you have any questions about any of this, please give me a call. If you can think of someone who might be interested in this, please forward it on. Otherwise, that's it for this week. Thanks for watching. We'll see you next week.